Hello, and welcome to the May Market Update. My name is Brad McMillan. I'm Commonwealth's Chief Investment Officer. We're going to talk about a couple of things this month. First, the economy. It's doing much better than we expected, and that's a good thing. Second of all, the stock markets. We had some turbulence this month, and that's worth a look for what it means going forward. Third, taking a look at some of the risks that we really need to be aware of and what that's going to mean for you and your investments. Let's start with the economy. The big news this month was improving employment. I've been calling the first couple of months of this year the snowdown. Not the slowdown, the snowdown, because the expectation was it was weather related. And as the numbers start to come in, as the weather has improved, we're finding that yes, it really was the weather that was the problem. Employment came in March much stronger than expected. And for April, it came in much stronger at 288,000, which is higher than it's been for a long time and well above expectations. What does that mean? Well, it means the economy is getting stronger. Jobs equate to wages, which equates to spending, and we saw both retail sales and personal consumption go up substantially. Again, much more than expected and at very healthy levels. So what we're seeing is the economy not only recover, but accelerate in its recovery. And that is exactly what we want to see as we continue to move towards normality. We also saw a milestone this month in that private employment moved back to a new all-time high. It's higher than it was from before the financial crisis. So we continue to normalize the economy. And again, this is a very positive factor. The problem is, though, this does not necessarily seem to be equating into the financial markets. The stock market actually had quite a bit of turbulence in the middle of the month. It dropped 2 to 3%, even though it finished at about the same level. So the stability for the whole month conceals a lot of turbulence. And what happened there is a lot of the high-flying stocks, the biotech stocks, some of the technology stocks, which had been running up like mad, suffered a severe correction. That drove the NASDAQ down. The NASDAQ actually finished with about a 2% loss for the month. And even though the major indices, the S&P and the Dow, recovered, they still suffered some technical damage. So if we look at the month as a whole for the stock markets, we don't have to be seriously concerned, but we do have to be watchful because some damage was done. Some of the leaders of the market have started to pull back. And the problem is this is occurring in the context of earnings moderating. We haven't seen the growth that we saw in previous quarters and frankly that the market was expecting. So what's happened is earnings are starting to moderate. Investors are getting less confident in the market. And combined with all of that, we're also getting uncertainty from the international environment. All of this combines to make the stock market something we want to watch. And the bond market is ratifying that by having interest rates actually drop during the course of the month. That too is driven by the international environment. Russia and Ukraine is something that the market initially thought, oh, no problem. But that's turning out not to be the case. And that's a potential issue that could ratchet up and really rattle markets going forward. We're continuing to watch that. China is another concern, but that's more of a slower moving concern. Something, again, we're watching, but not particularly worried about at this moment. So to sum up, the economy continues to heal, continues to normalize. I think we're probably going to have a pretty good spring and summer. Stock market, no immediate reason for concern, but something we want to keep an eye on and something we will be keeping an eye on. Thank you for joining us, and I'll talk to you next month.